Imagine discovering money you didn't even know was yours. Or, maybe even better, preventing it from ever leaving your pocket in the first place. In a world where, let's be honest, every dollar counts, the idea of legitimate, significant tax savings can feel a bit like finding hidden treasure. And well, that's exactly what we're setting out to uncover in this deep dive. Today, we're plunging headfirst into your shared sources on tax computations. We're really focusing specifically on the incredible power of tax credits. Our mission isn't just to explain the rules, okay? It's to really illuminate how these often overlooked provisions can directly reduce your tax liability. And, in some cases, even put money back into your hands. It's all about revealing those tangible financial benefits.
Indeed. And we're aiming to go beyond just the numbers today. We want to show you how these mechanisms, particularly tax credits, actually translate into real-world dollars for you, the individual taxpayer. It's really about empowering you with the knowledge to actively optimize your financial well-being and to identify concrete ways to truly hold on to more of what you earn.
Okay, let's unpack this then. Before we zoom in on those exciting savings, we kind of need to understand the fundamental ground rules, right? Most people know we have income taxes, but what does progressive truly mean for your wallet? Because I think, honestly, a lot of people misunderstand that part.
You've hit on a common misconception right there. Yeah. What's fascinating about our tax rate structure is that it's progressive. Now, this isn't just jargon. It means your marginal tax rate, and that's the rate applied to your next dollar of income increases as your taxable income goes up. But here's the crucial part, the bit people often miss. It doesn't mean all your income is taxed at your highest rate. No. Instead, your income gets divided into different portions, different buckets, you could say, and each portion falls into a specific tax bracket with its own rate attached.
So just to be super clear here, if I end up in, let's say, the 24% bracket, it's not like my entire paycheck suddenly gets hit with a 24% tax.
Exactly. That's the key aha moment for so many people. Think of it like a series of steps, or buckets. For 2023, the ordinary income tax rates start low at 10%, and they go up to 12%, 22%, 24%, 32%, and finally 37%. So take a married couple filing jointly, for example. Your first $22,000 of taxable income is taxed at just 10%. Then the chunk of your income from $22,001 up to $89,450, that's taxed at 12%. It's only the income that falls into those higher buckets that actually gets taxed at the higher rate.
Okay, that makes a huge difference in understanding.
It really does.
Yeah.
Let's quickly illustrate this principle with a pretty common scenario. Imagine a single taxpayer with $100,000 of taxable income in 2023. Now, if all their income was simply multiplied by their highest bracket rate, which for a single filer at $100 would be 24%, well, they'd owe $24,000. Simple math, but wrong. That's not how it works. Because of this progressive structure, their actual tax liability is calculated differently. You apply the lower rates to the initial segments of their income first. You fill up the 10% bucket, and then the 12%, then the 22%, and only the highest portion gets hit with that 24% rate. When you do that tiered calculation properly, their total income tax liability actually comes out to $17,400.
Wow, $17,400 versus $24,000. That's a massive difference.
It is. That's all thanks to the progressive system.
So that marginal tax rate, you mentioned the rate on your next dollar. Why is understanding that specific rate so important for financial planning? How does it impact decisions we make?
Oh, it's absolutely crucial because it directly tells you the impact of any additional income you might earn. Think a bonus or maybe some freelance work. Or even more importantly for our deep dive today, it shows the true value of any tax saving strategies you might use, like deductions or credits. It's calculated technically as the change in tax divided by the change in taxable income. For instance, in the sources, there's this example of Mark, right? He's a married taxpayer, gets an extra $15,000 consulting check. Now, his total income pushes him into a higher bracket for part of that new income. You might think, oh no, 22% tax on that check.
Yeah.
But his marginal tax rate on that additional $15,000 is actually calculated to be 12.4%.
Only 12.4%, even though some of it landed in the 22% bracket.
Exactly, because some of that $15,000 filled up the rest of his 12% bracket first.
Yes.
Understanding this nuance means, the actual tax cost of earning an extra dollar, or conversely, the actual dollar benefit of a deduction or a credit. It's not always as simple as just looking at your highest bracket rate. That marginal rate is key.
Okay. Now, here's where it gets really interesting for those of us maybe looking at investments, stocks, maybe real estate. I've heard that not all income is treated equally when it comes to taxes, is it?
You heard right. If we connect this to the bigger picture, it highlights a really key distinction in the tax code. It's designed Really, to incentivize certain types of long-term investment. Long-term capital gains, that's the profit you make from selling assets you've held for more than a year, and qualified dividends, which is certain types of dividends from stocks. Well, these are taxed at what we call preferential rates.
Preferential rates, meaning lower rates.
Often, yes. Significantly lower than ordinary income tax rates. For 2023, these rates are 0%, 15%, and 20%.
0%.
Yes. For single filers in 2023, for example, you could actually pay 0% tax on your long-term capital gains and qualified dividends if your total taxable income is below $44,625. It jumps to 15% for income between $44,626 and $492,300. And only then does it reach the top rate of 20% for income over $492,300. And those income thresholds are different for married filing jointly, head of household, etc.
So why does this matter so much? What's the takeaway for someone investing?
Well, it means for certain types of investment income, the tax impact can be dramatically lower. This structure is a really powerful incentive for investors. It encourages strategic choices, like holding investments for longer periods, more than a year, to qualify for these lower rates, which in turn can significantly impact your overall financial returns and, your long-term wealth building. It's a pretty clear signal from the tax code about encouraging long-term investment over short-term speculation.
All right, fascinating stuff. Now for what you called the real power play in tax savings, tax credits. You mentioned people confuse them with deductions, and honestly, it's easy to do. They both save you money, right? So what's the fundamental difference, and why should we care so much about credits if we're trying to directly save money?
This is such a critical distinction to grasp for, like true financial optimization. You're right, they both save money, but how they save money is totally different.
Yeah.
Deductions. Okay. Deductions reduce your taxable income. They lower the amount of income that the government can actually tax in the first place. Let's make that really clear with an example. Imagine you have a $1,000 tax deduction. If you're in, say, a 120% marginal tax bracket, that $1,000 deduction only saves you $200 because it just lowers your taxable income by $1,000, and you save 20% of that amount in tax. It's like taking a chunk out of the cake before you slice it up for taxes.
All right, $200 savings from a $1,000 deduction in that case. But with a credit, it's different.
Precisely. Completely different math. If you have a $1,000 tax credit, it saves you the full $1,000 because the credit is taken directly off the amount of tax you actually owe, dollar for dollar. It's like taking a $1,000 bill directly out of the pile you owe the IRS.
Yeah.
This direct reduction is what makes them incredibly powerful tools for keeping more money in your pocket. Credits are truly the most direct route to, well, tax relief.
Dollar for dollar, that's the phrase to remember.
Absolutely.
Yeah.
Now, within the world of credits, there are two basic types. Understanding these is key to knowing whether you might actually get money back or just reduce your bill to zero. First, we have non-refundable credits. These credits, they can reduce your tax liability right down to zero, which is great, but they won't result in a cash refund. So if your tax bill is, say, $500 and you qualify for a $1,000 non-refundable credit, your tax bill goes to zero. Fantastic. But that extra $500 of credit, it just vanishes. It doesn't come back to you as cash. Common examples include the Child and Dependent Care Credit, the credit for the elderly and permanently disabled, the Lifetime Learning Credit, and the Retirement Savings Contributions Credit. That's the Saver's Credit.
Okay, so non-refundable gets you down to zero, but no further. If
Mhm.
you're aiming for that money back in your pocket feeling, that's where refundable credits come in, right?
That's exactly it. On the other hand, we have refundable credits. And these are the ones that can truly generate an aha moment for your financial planning, maybe even a nice surprise at tax time. As their name suggests, they can result in a cash refund when the credit amount is more than your tax liability. And this is true even if you had zero tax withheld from your wages during the year. So, same scenario. Your tax liability is $500, but this time you have a $1,000 refundable credit. Your tax bill still goes down to zero, but then you also receive a $500 refund check from the IRS.
That's amazing. So you get the difference back.
You get the difference back. Key examples of these really impactful refundable credits include parts of the child tax credit, the earned income credit, and a big chunk, 40% of the American Opportunity Tax Credit for education. Plus, any federal income tax withheld from your W-2 wages and any excess Social Security tax paid if you had multiple jobs. Those are also treated like refundable payments. These refundable credits are particularly impactful for lower income taxpayers, often providing a direct, much-needed financial boost.
Okay, this is super helpful. Let's dive into some specific credits now. Let's start with a big one for families trying to manage, daily living expenses, the Child and Dependent Care Credit. How does this help parents save money, especially if, say, both parents are working or one is studying?
Right. This credit is specifically designed to alleviate some of that financial burden. It helps working families by offsetting the costs for care that, crucially, enables them to work or look for work. It's a percentage, usually between 20% to 35%, of those work-related expenses you incur for caring for qualifying persons. Now, there's a limit on the expenses you can claim. For 2023, the maximum expenses eligible are $3,000 for one qualifying person or $6,000 for two or more qualifying persons. This is direct financial relief for families who need childcare to be gainfully employed.
And who qualifies as a qualifying person, and what about the parent's work status?
Good questions. A qualifying person is typically your dependent child who was under age 13 when the care was provided. Or it could be a disabled dependent of any age who cannot care for themselves, or even a disabled spouse. As for the parents, if you're married, generally, both spouses must have earned income during the year. There are exceptions, though. If one spouse was a full-time student for part of the year, or was physically or mentally unable to care for themselves, they might be treated as having earned income for those months, allowing the other spouse to potentially claim the credit.
Makes sense. And what kind of expenses actually qualify? Is it just like traditional daycare centers?
That's a great clarification. It's broader than just daycare. Eligible expenses can include costs for a babysitter, a nanny, even before after-school care programs, or nursery school. The absolute key is that these expenses must be for the purpose of enabling you and your spouse, if filing jointly, to work or actively look for work. But it's important to note what doesn't count. For instance, tuition for elementary school, like first grade and up, generally doesn't qualify because that's considered primarily educational, not care-related. Also, things like overnight camp usually don't count fully.
Okay, and how is the actual credit calculated? You mentioned a percentage and a limit.
Right, so first you figure out your work-related expenses. Then, the amount of expenses you can actually use for the credit calculation is limited. It's the lowest of these three things. One, your actual work-related expenses paid. Two, the maximum allowable amount, $3,000 for one person, $6,000 for two or more. Or three, your earned income or your spouse's earned income, whichever is lower if married. Once you have that qualifying expense amount, you multiply it by a percentage. That percentage depends on your adjusted gross income, your AGI. The maximum rate is 35%, but that's only for very low AGIs, $15,000 or less. As your AGI goes up, the percentage phases down. For anyone with an AGI over $43,000, the rate settles at 20%. So for many families, say with two kids and an AGI over $43K, they take their eligible expenses up to $6,000, multiplied by 20% for a maximum credit of $1,200.
Gotcha. Can you walk us through an example, maybe?
Sure. Let's use Joanne Vega from the source material. She's a widow, has two dependent children under 13, and her AGI is $50,000. She paid $7,400 in qualifying expenses during the year for a home caregiver and nursery school so she could work. Now, even though her actual expenses were $7,400, the maximum amount she can use for the calculation for two children is $6,000. Since her AGI of $50,000 is over the $43,000 threshold, her credit rate is 20%. So we take the $6,000 eligible expense limit and multiply it by 20%. That gives her a credit of $1,200. That's $1,200 directly knocked off her tax bill. It's a significant help for managing those childcare costs, absolutely. And it really shows how the tax code aims to support workforce participation for parents.
That's a great example. Okay, moving on. Let's talk about supporting our seniors and also individuals living with permanent disabilities. They often face unique financial pressures, often on fixed incomes. What kind of tax relief does the code offer here? How does it help them keep more of their money?
Yeah, there's a specific credit for this group. It's the credit for the elderly and/or permanently disabled. It's calculated as 15% of an initial base amount, and it's designed precisely to provide some financial relief for that demographic. To be eligible, you generally need to be either 65 or older by the end of the tax year. Or you could be under 65 but retired on permanent and total disability, and you must receive taxable disability income during the year. The initial base amount used to figure the credit varies by filing status. For a single person, it starts at $5,000. If you're married filing jointly and both spouses qualify, the base amount starts at $7,500. There are a few other variations depending on the specifics.
Okay, a base amount. But I imagine things like Social Security payments or other income affect this credit, right? Does it reduce the potential benefit?
That's a very important point, yes. Because many seniors rely heavily on Social Security. And yes, the base amount, that $5,000 or $7,500 starting point, is reduced by certain non-taxable income streams. Specifically, it's reduced by any non-taxable Social Security benefits you receive. It's also reduced by other non-taxable pensions or annuities. And additionally, it's reduced by half of your adjusted gross income AGI, that exceeds specific thresholds. For single taxpayers, that AGI threshold is $7,500. For married persons filing jointly, it's $10,000. So these reductions can significantly lower the base amount on which that 15% credit is actually calculated. Sometimes it reduces it all the way to zero.
Right, so it's really targeted. Can you give us an example here too?
Let's look at Peter's situation from the sources. Peter is single, he's 68 years old. His AGI for the year is $8,060, and he also received $3,120 in non-taxable Social Security benefits. Okay, so for Peter, being single and over 65, the initial base amount is $5,000. First, we subtract his $3,120 in Social Security. That brings the base down to $1,880. Next, we look at his AGI. It's $8,060, which is over the $7,500 threshold for single filers. The excess is $560, $8,060, $7,500. We need to subtract half of that excess AGI, so half of $560 is $280. We subtract that $280 from the remaining base amount, $1,880, $280. That leaves $1,600. This $1,600 is the final amount eligible for the credit. We apply the 15% credit rate to it. 15% of $1,600 is $240. So Peter receives a $240 non-refundable credit.
Okay, $240. It might seem like a modest amount, maybe.
It might seem modest, but for someone on a fixed income, every single dollar helps, right? And this credit offers tangible tax relief, specifically targeted at seniors and individuals managing disabilities. It recognizes their unique circumstances.
Absolutely. Okay, now for a big one, for anyone investing in their future or their children's future, education. This can involve some really significant expenses, but the good news is there seem to be multiple ways to save on taxes related to education. Let's talk about the American Opportunity Tax Credit first. I hear this one often highlighted as a real game changer.
Yeah, education incentives are incredibly powerful tools, and you're right, they're often underutilized. The American Opportunity Tax Credit, or AOTC, truly is fantastic, but it's got specific rules. It's specifically for the first 4 years of post-secondary education, think undergraduate degrees. It offers a maximum credit of $2,500 per eligible student. How it's calculated is, you get 100% credit on the first $2,000 of qualified education expenses you pay for the student. Plus, you get 25% credit on the next $2,000 of expenses paid. So $2,000 plus 0.25, $2,000, also $2,500 max. And crucially, qualified expenses here cover not just tuition and required fees, but also books and other required course materials. That's often overlooked, but adds up.
And you mentioned something about it being refundable. That sounds important.
Yes. This is a key benefit for financial planning with the AOTC. 40% of this credit is refundable, up to a maximum refund of $1,000 per student. $2,500 max credit, 40%. This is huge because it means even if you have zero tax liability, you could still get up to $1,000 back from the government as a cash refund. That's a real game changer for many students and families.
Yeah.
It's calculated on a per-student basis, so if you have multiple eligible kids in college, you can claim it for each one. The student does need to be enrolled at least half-time for at least one academic period during the year. And like many credits, it does phase out based on income. For 2023, the phase-out begins at a modified AGI of $80,000 for single filers and $160,000 for married filing jointly.
Okay, first 4 years per student, partially refundable. What about the lifetime learning credit? How does that compare? Who is that one really designed for? Because, learning doesn't stop after 4 years.
Exactly. The Lifetime Learning Credit, or LLC, is much broader in scope. It's really designed for ongoing education and skill development throughout your life. It's available for an unlimited number of years. It covers undergraduate courses, graduate courses, professional degree courses, or even courses taken just to acquire or improve job skills. It doesn't have to be towards a degree. It's equal to 20% of the first $10,000 of qualified education expenses paid during the year. So the maximum lifetime learning credit you can get is $2,000, 20% of $10,000. But here are some key distinctions from the AOTC. For the LLC, qualified expenses generally include only tuition and required fees, not usually course materials like books, unless required to be paid directly to the institution. Also, the $2,000 maximum is per taxpayer or per tax return, not per student.
Ah, okay. So even if I'm paying tuition for myself and my spouse taking night classes, I still only get one maximum $2,000 LLC.
That's exactly right. It's a per return limit, regardless of how many students are involved. It also has a similar AGI phase-out range as the AOTC, starting at $80,000, single $160,000 married, filing jointly for 2023. And it's non-refundable.
So if I have, say, 2 kids in college, one in their second year and one maybe taking a single graduate course, can I claim both credits in the same year, or do I have to pick just one?
That's a fantastic question, and it really highlights the strategic flexibility built into these education incentives. You absolutely do not have to choose just one type of credit for your entire tax return for the year. For example, a parent could claim the lifetime learning credit for the expenses of one child taking that graduate course. And simultaneously, they could claim the American Opportunity Credit for the other child who is in their second year of undergraduate study, assuming all other eligibility rules are met for both. However, and this is crucial, you cannot claim more than one education credit for the same student in the same year. So for each individual student, you need to look at their specific situation year in school, course load, expenses, and figure out which credit, AOTC or LLC, offers the most tax benefit for that student. You can mix and match credits across different students on the same return. This flexibility is a huge tax-saving opportunity for families paying for multiple students.
That's really good to know. Okay, beyond these direct credits, what about dedicated savings accounts for education? How do they offer tax benefits, and what are the main options there?
Right, this brings us to long-term planning for those potentially huge education expenses down the road. Two prominent options here are Coverdell Education Savings Accounts, ESAs, and Section 529 Qualified Tuition Programs. Their core benefit, the real magic, is tax-advantaged growth. The earnings inside these accounts accumulate tax-free. And then when you take the money out and use it for qualified education expenses, those distributions are also tax-free at the federal level and often at the state level too. This means you don't pay tax on the investment growth, which can be incredibly substantial over, say, 18 years.
Okay, tax-free growth, tax-free withdrawals for education. What's the difference between a Coverdell ESA and a 529 plan?
There are a few key differences. Coverdell ESAs have much lower annual contribution limits, currently $2,000 per year, per beneficiary, the student. Contributions are non-deductible, meaning you don't get an upfront tax break. And there are income limits for contributors. But a big advantage of Coverdells is that they can be used for qualified expenses for K-12 education, not just higher education. Think private school tuition, tutoring, uniforms, etc. Section 529 plans, on the other hand, are generally state-sponsored. They often have much, much higher contribution limits, sometimes hundreds of thousands of dollars over the life of the plan. They primarily cover qualified higher education expenses, college tuition, fees, books, supplies, required equipment, and even reasonable room and board costs if the student is enrolled at least half-time. Some recent changes also allow limited 529 funds to be used for K-12 tuition or even student loan repayment, but higher ed is still the main focus.
Okay, so Coverdell for smaller amounts, maybe K-12 flexibility. 529 for potentially larger savings focused on higher ed. Now, can I use money from one of these savings accounts and still claim an AOTC or LLC for the same student in the same year?
The double-dipping question. Yes, you can, but with a crucial rule to prevent actual double-dipping on the same expenses. You can claim the American Opportunity Tax Credit or Lifetime Learning Credit in a tax year and also take a tax-free distribution from a Coverdell or 529 plan for the same student. However, you cannot use the same dollar amount of educational expenses for both benefits. For instance, let's say you paid $10,000 in qualified college tuition. You take a $5,000 tax-free distribution from a 529 plan to cover part of it. You could potentially use the remaining $5,000 of tuition expenses to claim an education credit, like the AOTC or LLC, assuming you meet the rules for those credits. You just can't count that first $5,000 towards the credit and take it out tax-free from the 529. This strategy allows you to kind of layer the benefits, maximizing your overall savings. It just requires careful tracking of expenses.
Okay, careful tracking is key. Got it. Let's shift gears to something really meaningful, the adoption credit. This helps families growing through adoption offset what can be incredibly significant costs, right?
Absolutely. What's truly impactful here is the direct financial support the tax code provides for qualifying adoption expenses. For 2023, the maximum adoption credit allowed is quite substantial. It's the amount of qualified adoption expenses you paid, up to $15,950 per eligible child. It's a non-refundable credit, meaning it can only reduce your tax liability down to zero. But, and this is a crucial feature given the high costs involved, any credit amount that's in excess of your tax liability for the year may be carried forward for up to 5 years. This carry-forward provision can be a real lifesaver, allowing families to benefit from the full credit over time, making it a powerful tool for financial relief.
$15,950 is significant. Are there income limits on who can claim this?
Yes, there are. Like many credits designed to help with specific costs, there's an income limitation based on your modified adjusted gross income, or MAGI. For 2023, the credit begins to phase out for taxpayers with MAGI over $239,230. And it's completely phased out, meaning you can't claim it at all if your MAGI is $279,230 or more.
Okay. And What kind of expenses can families actually claim towards that $15,950 limit? What counts?
Good question. Qualified adoption expenses include all reasonable and necessary expenses, costs, and fees that are directly related to and have the principal purpose of the legal adoption of an eligible child. This covers a wide array of things like adoption fees, court costs, attorney fees, travel expenses, including meals and lodging while away from home, and other expenses directly related to the legal adoption process. However, it's also important to know what doesn't qualify. You can't claim the credit for expenses incurred in adopting the child of your spouse. It's also not available for costs associated with a surrogate parenting arrangement. And general medical expenses related to the child typically don't qualify unless they were directly part of the adoption service fees.
And what about the timing? When do you claim the credit? When the adoption's final, or when you pay the bills?
The timing depends a bit on the type of adoption and when expenses are paid. For the adoption of a U.S. child, you generally claim the expenses in the year after they are paid, unless the adoption becomes final in the same year you paid them. For a foreign adoption, there's a stricter rule. You generally cannot claim the credit until the adoption becomes final. So even if you paid expenses in earlier years, you wait until the finalization year to claim them all, subject to the annual limit. This ensures the credit aligns with the completion of the adoption process, especially for international cases.
Okay, that makes sense. Now let's talk retirement savings. Many people want to save, but especially those with lower or moderate incomes face real financial hurdles. Is there a specific tax incentive, like a credit, to help these savers get started, to give them a little boost?
Absolutely. And this is honestly one of my favorite incentives in the tax code because it directly supports such a vital long-term financial goal, saving for retirement. It's officially called the Retirement Savings Contributions Credit, but most people know it as the Saver's Credit.
Sure.
It's a non-refundable tax credit specifically designed for low and moderate income taxpayers who make contributions to a qualified retirement plan. This could be an employer-sponsored plan like a 401k, 403b, or governmental 457b plan, or it could be a traditional or Roth IRA. It's an incredibly direct way to essentially get a bonus from the government just for saving for your own retirement.
A bonus just for saving. That sounds great. Who qualifies and how much can someone actually get from this credit?
To be eligible, you need to meet 3 basic criteria. You must be at least 18 years old, you cannot be claimed as a dependent on someone else's tax return, and you cannot have been a full-time student during the year. As for how much you can get, the credit itself is calculated as a percentage, 10%, 20%, or even 50% of the first $2,000 you contribute during the year. If you're married filing jointly, each spouse can potentially qualify based on their own contributions up to $2,000 each. So the absolute highest credit a single person could receive is $1,000, $2,000 contribution multiplied by the top 50% rate. For a married couple filing jointly, the maximum potential credit is $2,000.
Okay, 10, 20, or 50%. What determines which rate you get? It depends entirely on your filing status and your adjusted gross income, or AGI. The lower your AGI, the higher the credit percentage. For example, let's take a single filer in 2023. If their AGI is $21,750 or less, they qualified for that top 50% rate. So a $2,000 contribution gets them a $1,000 credit. If their AGI is slightly higher, say between $21,751 and $23,751, their rate drops to 20%. A $2,000 contribution now gets them a $400 credit. And if their AGI is between $23,751 and $36,500, the rate is 10% for a maximum credit of $200. The AGI thresholds are higher for married filing jointly and head of households. This tiered approach ensures that those with lower incomes receive the greatest direct financial incentive to save, providing a really tangible return on their savings efforts. It's basically the government saying, we know saving is tough, here's some direct help to make it happen.
That's fantastic. A real boost for lower income savers. Okay, let's circle back to families. Another really big one is the child tax credit. This one seems to get a lot of attention and has changed over the years. What are the key details for 2023, and how does it offer tax savings?
Yes, the child tax credit is a very significant benefit for millions of families. For the tax years 2018 through 2025, under current law, it offers a credit of up to $2,000 for each qualifying child. Now, to be a qualifying child for this specific credit, they generally must be under the age of 17 at the end of the tax year. They also need to be your dependent and meet other criteria, including being a U.S. citizen, national, or resident alien. It's a very direct way to reduce a family's overall tax burden.
$2,000 per child under 17. Does everyone get the full amount? Or are there income limits here too?
There are income limits. It's designed to benefit most families, but for higher income taxpayers, the credit does begin to phase out. The $2,000 credit starts to be reduced if your modified adjusted gross income, MAGI, goes above certain thresholds. For those married filing jointly, that threshold is $400,000. For all other filers, single, head of household, married filing separately, the threshold is $200,000. For every $1,000 or fraction thereof that your MAGI is over that threshold, the total credit amount for all your children is reduced by $50.
Okay, so it phases out for higher earners. But what makes this credit so impactful for many families is that term we heard earlier, refundable. How does that work for the child tax credit?
Right, that refundability aspect is crucial. While the child tax credit is primarily non-refundable, meaning it first offsets the tax you owe, a significant portion of it can be refundable. This part is sometimes called the additional child tax credit, but it's calculated as part of the main credit. Specifically for 2023, the maximum refundable amount per qualifying child is $1,600. However, the actual refundable amount you receive is limited. It's the lesser of 1. The unclaimed portion of your $2,000 credit after reducing your tax liability. 2. 15% of your earned income that's over $2,500. Or 3. That's $1,600 per child maximum. That calculation sounds a bit complicated, but the bottom line is, this refundability means that even if you owe very little or no income tax, you could still receive up to $1,600 per child back as a direct cash refund. This is why it's such a game changer for many working families, especially those with lower or moderate incomes, as it provides a really tangible infusion of cash.
That makes a huge difference. And what about dependents who aren't under 17, like older kids or maybe an elderly parent you support? Is there anything for them?
Yes, there is. To round out the picture for dependents, there's also what's sometimes called the credit for other dependents. This provides a $500 credit for each dependent who meets the general dependency rules but doesn't qualify for the $2,000 child tax credit. This typically includes children who are age 17 or older at the end of the year, including college students you still support. It also includes other qualifying relatives you support, like maybe an elderly parent or a disabled sibling living with you. Now, unlike the main child tax credit, this $500 credit is entirely non-refundable. It can only reduce your tax liability down to zero. It won't result in a refund itself. And it's subject to the exact same income phase-out thresholds, $400K MFJ, $200K others, as the primary child tax credit.
Okay, $500 non-refundable for other dependents. Good to know. Now let's talk about a credit that's often described as one of the most effective anti-poverty programs in the country. Tell us about the Earned Income Credit, or EIC. What's its purpose? And what's its incredible potential for direct financial support?
The Earned Income Credit, or EIC, yes, it's truly a critically important credit. It's specifically designed to assist low and moderate income working individuals and families. The emphasis is on earned income. The absolute key takeaway here, the thing that makes it so powerful, as the source material underscores, is its refundability. This is huge. It means the EIC can directly result in a substantial cash refund that goes right into your pocket, even if you don't owe any income tax at all. It effectively acts as a wage supplement for lower earners. It's a powerful tool for boosting income and helping families make ends meet.
So it really is about rewarding work even at lower income levels. What are the eligibility requirements? Is it complicated?
There are several requirements, yes. You must have earned income from working for someone else or from running your own business or farm. You generally must live in the U.S. for more than half the year. You need to meet certain earned income and adjusted gross income thresholds, which vary depending on your filing status and the number of qualifying children you have. You also cannot have too much investment income for 2023. The limit was $11,000. There are also age requirements if you don't have qualifying children. Generally, the taxpayer and spouse, if married, must be between ages 25 and 65. And if you're married, you usually must file a joint return to claim the EIC.
Okay. And how does having children impact this credit? Does it make a big difference?
It makes a huge difference. While you can be eligible for the EIC without having a qualifying child, though the credit amount is much smaller, having one or more qualifying children significantly increases the credit percentage and the income levels at which you can claim the credit. This makes the potential credit amount much, much larger. For EIC purposes, a qualifying child is broadly defined. It can be your son, daughter, adopted child, stepchild, foster child, or even a descendant like a grandchild. Or it could be your sibling, half-sibling, step-sibling, or their descendant, like a niece or nephew. They need to meet specific age requirements, generally under 19 or under 24 if a full-time student, or any age if permanently and totally disabled. They also must have lived with you in the U.S. for more than half the year and meet other tests.
And the credit amount itself varies a lot based on kids.
Dramatically. Let's look at the maximum credit amounts for 2023 just to illustrate. For a taxpayer with no qualifying children, the maximum EIC was $600. With one qualifying child, the maximum jumped to $3,995. With 2 qualifying children, it went up to $6,604. And if you had 3 or more qualifying children, the maximum EIC reached $7,430. As you can see, those are potentially life-changing amounts for families working hard but struggling to get by.
Wow, that's a massive difference. Can we see how it works with an example? Maybe someone without kids first?
Sure. Let's look at Karen's situation from the source. Karen is 26 years old, single with no dependents. In 2023, her gross income from her job was $12,000. Based on the EIC tables and phase-out rules for someone with her income and no children, Karen was eligible for an earned income credit of $432. So even for an individual without children, this credit can provide meaningful direct financial support, a real boost on top of her wages. It's a clear, measurable benefit directly tied to her work effort.
Great example. Okay, let's shift perspective a bit. For those with international ties, perhaps working abroad, owning foreign property, or having foreign investments, is there a way to avoid the dreaded double taxation, being taxed by both the U.S. and another country on the same income?
Indeed, that's a very common concern for people with global connections, and thankfully, the U.S. tax code has a mechanism to address it, the foreign tax credit. This credit allows U.S. taxpayers to claim a credit against their U.S. income tax liability for certain income taxes they've paid or accrued to a foreign country or a U.S. possession. Now, you do technically have the option to deduct these foreign income taxes as an itemized deduction instead of taking the credit, but a credit is almost always more beneficial. Why? Because we keep saying a credit directly reduces your U.S. tax liability dollar for dollar. A deduction only reduces your taxable income, giving you a benefit equal to the deduction amount times your marginal tax rate. So the credit usually saves you more.
Okay, so the credit is usually better. Are there limits on how much foreign tax credit you can claim?
Yes, absolutely. There's a key limitation. The amount of foreign tax credit you can claim in any given year is limited. It's the lesser of 1, the actual amount of foreign income tax you paid or accrued, or 2, a calculated U.S. tax liability limit. This limit is basically designed to ensure that the credit only offsets U.S. tax on your foreign source income. You can't use foreign taxes to reduce the U.S. tax you owe on your U.S. source income. The calculation can get a bit complex, often requiring Form 1116. But the good news is, if your foreign taxes paid exceed this limitation in a given year, that disallowed amount isn't necessarily lost forever. Any disallowed foreign tax credit, the amount you couldn't use, can generally be carried back 1 year and then carried forward for up to 10 years. This offers valuable flexibility in managing your tax burden over a longer period if your foreign income or taxes fluctuate.
Carry back and carry forward, that's helpful. Okay, what about credits specifically for businesses? How do they save? And maybe more importantly, what kinds of behaviors do these credits encourage? Are they just for massive corporations, or can smaller businesses benefit too?
That's a great question, and it's important to know that many business credits are actually designed to incentivize specific positive economic and social behaviors across businesses of all sizes, not just the giants. There's something called the General Business Credit. Now, this isn't a single credit itself, but rather an umbrella term. It's a combination of a whole bunch of different individual business-related credits, all rolled into one calculation on Form 3800. This includes things like the investment credit, related to certain energy properties, for example, the increased research credit, which gives businesses a credit for boosting their qualified research spending above a base amount, and the low-income housing credit, which encourages investment in affordable housing. There are many others, too. This combined general business credit is generally limited based on your net income tax liability for the year. But again, the good news is that any portion of the general business credit that you can't use in the current year due to the tax liability limitation can typically be carried back 1 year and then carried forward for up to 20 years. This provides a potentially long-term tax benefit for businesses making these qualifying investments or undertaking these incentivized activities.
Okay, so it's a bundle of different credits. Can you give an example of one specific credit within that bundle that encourages a certain behavior?
Sure. A really good example is the Work Opportunity Credit, or WOTC. This credit provides a direct incentive for employers to hire individuals from certain targeted groups, people who have historically faced significant barriers to employment. By hiring someone from one of these groups, the employer can claim a credit. For most targeted groups, the credit is generally equal to 40% of the first $6,000 of qualified first-year wages paid to that employee, so a maximum credit of $2,400 per employee. For certain qualified summer youth employees, it's 40% of the first $3,000 wages. So it's a direct financial reward for businesses that open doors and provide jobs for these specific populations. It helps the business's bottom line while also supporting important social and economic goals.
And what are some of those targeted groups?
The list includes quite a few categories. Examples include certain qualified veterans, especially those unemployed or disabled, recipients of temporary assistance for needy families, TANF, recipients of Supplemental Nutrition Assistance Program, SNAP, or food stamps, individuals living in designated empowerment zones or rural renewal counties, ex-felons hired within a year of conviction or release, individuals referred from vocational rehabilitation programs, and the long-term unemployed.
That's quite a range. Okay, let's focus specifically on small businesses now. You often hear they're the backbone of the economy, but they definitely struggle sometimes with offering the kinds of benefits that larger companies can provide more easily, like retirement plans or health insurance. Are there special tax incentives, special credits, targeted specifically at helping small businesses with these things?
You're absolutely right about the challenges small businesses face, and yes, the tax code does include specific incentives designed to support them in offering these crucial benefits to their employees. One really important one is the Small Employer Retirement Plan Startup Costs Credit. This offers genuine financial relief, a tax credit for the administrative costs associated with setting up a new qualified retirement plan, like a 401k, a civil IRA, or a SEP IRA. To be eligible, an employer generally must have had no more than 100 employees who received at least $5,000 in compensation in the preceding year. And the plan has to cover at least one employee who is considered non-highly compensated. The credit is available for the first 3 years that the plan exists. It helps cover the ordinary and necessary cost to actually establish and administer the plan, and also cost to educate employees about the plan. The credit amount itself can be quite generous, potentially covering a significant portion of those setup costs, especially for very small employers. It's a clear encouragement from the government for small businesses to start offering these vital retirement benefits, helping their employees save for the future.
Can you show how that calculation works?
Sure. The credit calculation has a few tiers. For employers with 50 or fewer employees, the credit is the greater of 1, $500, or to the lesser of $250 for each eligible, non-highly compensated employee who's eligible to participate in the plan, or are $5,000. Plus, there can be an additional credit related to employer contributions for smaller employers. Let's use Alice from the source material. She starts a SEP IRA for her small business, which includes herself and 2 employees. Her eligible startup costs were $1,200. Based on the rules for her situation, assuming 50 or fewer employees, she qualified for a credit equal to 50% of her eligible startup costs up to a certain limit, plus potentially other amounts. Let's simplify and say, based on the full calculation in the example, she qualified for a $1,000 credit. That's $1,000 directly off her business's tax bill, offsetting a huge chunk of her $1,200 startup cost. That makes offering a retirement plan much more feasible for a small operation like hers.
That really lowers the barrier to entry. What about health insurance? That's another huge expense for small businesses.
Absolutely. And there's a credit for that too, although its rules are quite specific. It's the Small Business Healthcare Tax Credit. This credit is designed to help eligible small employers afford the cost of providing health insurance coverage to their employees. Generally, to be eligible, the employer must have fewer than 25 full-time equivalent employees, pay average annual wages below a certain inflation-adjusted amount, around $62,000 for 2023. And this is key, contribute at least 50% towards the cost of employee-only health coverage for each enrolled employee. Also, the coverage generally must be obtained through the Small Business Health Options Program, SHOP Marketplace, although there are exceptions in areas where SHOPs aren't available. If an employer meets all these criteria, they can potentially claim a credit for up to 50% of the premiums they paid for their employees' coverage. The rate is lower, up to 35% for tax-exempt employers. So it's specifically designed to help the smallest businesses, those with lower wage workers, make quality health insurance more accessible.
Up to 50% of premiums paid. That could be substantial. Is this credit refundable?
No, this particular credit is non-refundable. It can only reduce the employer's tax liability down to zero. However, like some other business credits, if the employer can't use the full credit amount in the current year because their tax liability isn't high enough, they can generally carry the unused portion back 1 year and then forward for up to 20 years. This provides long-term financial relief. It's also important to note that any premiums paid for owners of the business or their family members are typically excluded when calculating the credit amount. It's focused on the cost of covering the rank-and-file employees.
Okay, good to know. Now, shifting back to individuals for a moment, for people who don't get health insurance through an employer and maybe need help affording the premiums on their own plan, there's another credit that offers significant relief rate, especially with the rising cost of healthcare we keep hearing about.
Yes, absolutely. That would be the premium tax credit, or PTC. This is a really important one for healthcare affordability. It's a refundable tax credit designed to help eligible individuals and families with low or moderate incomes afford health insurance premiums for plans purchased through the health insurance marketplace, also known as the ACA exchange or Obamacare. What's particularly impactful and different from many other credits is how you can receive the PTC. You don't have to wait until you file your taxes. You can estimate your income for the upcoming year when you enroll in a marketplace plan, and you can choose to have advance payments of the premium tax credit, APTC, paid directly to your insurance company throughout the year. This lowers your monthly premium payments right away, making the insurance much more affordable on a month-to-month basis.
So you get the help up front, essentially.
Exactly. It offers instant financial relief. Of course, when you file your tax return at the end of the year, you'll reconcile the advance payments you received with the actual premium tax credit you qualify for based on your final income. If you receive too much advance credit, you might have to pay some back. If you received too little or didn't take any advance payments, you'll get the difference as a refundable credit on your tax return. But that option for advance payment makes healthcare significantly more accessible in real time for those who qualify, acting as a crucial and timely way to manage those monthly living costs.
That immediate help makes a big difference. Okay, we've talked a lot about getting credits, which is fantastic, but tax planning isn't just about getting credits. It's also about proactively avoiding penalties that can, eat into your savings or your refund. Let's talk about estimated taxes. I feel like this can be a real trap for the unwary, especially for freelancers, gig workers, or people with significant investment income. Oh, absolutely. That's a critical point for financial health. Estimated taxes are crucial for anyone who expects to owe taxes beyond what's withheld from wages. This includes, as you said, self-employed individuals, independent contractors, partners, S-corp shareholders, or people with substantial income from interest, dividends, capital gains, alimony, or rent, where little or no tax is withheld. You're generally required by law to pay federal income tax as you earn income throughout the year. If you expect to owe at least $1,000 in tax when you file your return, after subtracting withholding and credits, you usually need to make estimated tax payments. These are typically paid in 4 quarterly installments throughout the year.
Okay, quarterly payments. How do you know how much to pay to avoid getting hit with a penalty for underpayment?
That's the million-dollar question, isn't it? The IRS doesn't want to penalize people unnecessarily, so they provide safe harbor rules. Meeting one of these safe harbors generally protects you from the underpayment penalty. The 2 main safe harbors are: 1. Pay at least 90% of the tax to be shown on your current year's tax return. This can be tricky because you have to estimate your current year tax. 2. Pay at least 100% of the tax shown on your prior year's tax return, assuming your prior year return covered all 12 months. This is often easier because you know your prior year tax amount. There's an important exception to that second rule. If your adjusted gross income, AGI, in the prior year was more than $150,000 or $75,000 if married filing separately, you generally need to pay at least 110% of your prior year's tax to meet that safe harbor. So your total payments throughout the year, that's your withholding from jobs plus your quarterly estimated tax payments, need to meet one of these thresholds.
Okay, 90% of current year or 110% of prior year tax. What if someone realizes, say, late in the year, maybe in November, December, that they haven't paid enough through withholding in their earlier estimated payments? Are they just stuck facing a penalty? Or is there a last-minute trick?
This is where understanding the rules can really save you. What's fascinating here is a simple but incredibly powerful strategy that many people just don't realize exists. If, towards the end of the taxable year, you figure out, my estimated payments have been insufficient, I'm probably going to owe a penalty, you can often fix it. How? By dramatically increasing your income tax withholding from wages for the remainder of the year. The magic is that the IRS generally treats income tax withheld from your paycheck as if it were paid evenly throughout the entire year, regardless of when during the year it was actually withheld. So, if you go to your employer in December and submit a new Form W-4 instructing them to withhold a huge chunk of extra tax from your final paycheck, the IRS, for penalty calculation purposes, will generally spread that December withholding back evenly across all 4 quarters of the year. This last-minute action can significantly boost your total payments considered made for the earlier quarters, often reducing or even completely eliminating any potential underpayment penalty.
No way. So a big December withholding can retroactively cover shortfalls from earlier in the year.
For penalty calculation purposes, yes, generally. It's a brilliant, perfectly legal, last-minute way to protect your financial position and avoid that unnecessary penalty cost. You just need to act before year-end and adjust your W-4 accordingly.
That is a fantastic tip. Okay, what if the shoe is on the other foot? What if you actually overpay your taxes during the year, perhaps unknowingly? How do you get that extra money back into your own pocket? Because let's face it, nobody wants to give the government an interest-free loan.
You're absolutely right. Ensuring you don't overpay, or at least getting your overpayment back promptly, is a straightforward but still important form of, let's call it tax recovery, rather than tax saving. It's simple, really. All the federal income taxes withheld from your paychecks throughout the year, as shown on your Form W-2, are treated essentially as payments you've already made towards your total tax bill. The same goes for any estimated tax payments you made or other credits that function like payments. When you file your tax return, you calculate your actual total tax liability for the year. If the total amount of your withholding and payments exceeds that actual tax liability, the difference is an overpayment, and you simply receive that overpayment back from the IRS as a tax refund. It's a direct return of your money that you overpaid.
Okay, so refunds handle overpaid income tax. What about other taxes, like Social Security? Can you overpay that?
Yes, you definitely can, especially in one specific situation. Social Security tax, part of FICA, has an annual wage-based limit, meaning you only pay Social Security tax on your earnings up to a certain amount each year, $160,200 in 2023. If you work for 2 or more employers during the same year, and your total combined earnings from all jobs exceed that wage-based limit, it's very possible that each employer withheld Social Security tax up to the limit, resulting in you overpaying the tax in total. If this happens, you can claim that excess Social Security tax withheld as a credit against your income tax liability when you file your Form 1040. It gets added to your other payments and can increase your refund or reduce the tax you owe. However, and this is a crucial distinction, if the excess Social Security tax was withheld by only one employer, maybe they just made a mistake, then that employer is responsible for adjusting the tax and refunding the excess directly to you. You don't claim it on your tax return in that case. You need to get it back from the employer. So understanding that difference is key to reclaiming any overpaid FICA funds correctly.
Good distinction. Okay, we're nearing the end, but let's quickly touch on a few other key tax areas people should be aware of for holistic planning. First, for anyone who's self-employed, thinking about freelancing, or even just running a side hustle, what's the crucial thing to know about self-employment tax? It sounds like something beyond just regular income tax.
It absolutely is, and it's vital for entrepreneurs and freelancers to understand and plan for this. When you work for an employer, they pay half of your Social Security and Medicare taxes, FICA, and you pay the other half through payroll withholding. But when you're self-employed, you're essentially acting as both the employer and the employee. This means you are responsible for paying both halves the employer share and the employee share of FICA taxes on your net earnings from self-employment. This combined amount, currently 15.3% on earnings up to the Social Security wage base, plus 2.9% Medicare tax on all net earnings, is what's called the self-employment tax. It's calculated on Schedule SE and reported as an other tax on your Form 1040. It's in addition to your regular income tax.
Ouch, 15.3% plus more for Medicare. That sounds like a big hit. Is there any relief?
There is some built-in relief, yes. Here's the good news, and a key tax benefit associated with it. You get to deduct 1/2 of your calculated self-employment tax amount as an adjustment to your gross income. This deduction for 1/2 of self-employment tax is taken above the line, meaning you get it whether you itemize deductions or not. It helps arrive at your adjusted gross income, AGI. This adjustment effectively reduces your overall income that's subject to regular income tax, providing a partial offset for that additional SE tax burden. It recognizes that you're covering both the employer and employee shares, but still planning for that SE tax liability is absolutely critical for anyone working for themselves.
Definitely sounds critical. Okay, what about for higher earners again, especially those with significant investment income? Are there any other additional taxes they need to be aware of beyond the standard income tax rates and maybe SE tax? Things that can sneak up on you?
Yes, there are 2 main ones that apply specifically at higher income thresholds. These are important for comprehensive tax planning if you fall into these brackets. First, we briefly mentioned it earlier, but there's the additional Medicare tax. This is an extra 0.9% Medicare tax imposed on wages, self-employment income, and railroad retirement compensation that exceed certain thresholds. Those thresholds are $250,000 for married filing jointly, $125,000 for married filing separately, and $200,000 for all other taxpayers, single, head of household, qualifying widows. So once your wages or SE income cross that line, the excess gets hit with this additional 0.9% tax. Employers are required to start withholding it once an employee's wages exceed $200,000 in a year.
Okay, 0.9% more Medicare tax above those levels. What's the second one?
The second one, which often impacts investors significantly, is the net investment income tax, or NIIT, We touched on this too. This applies a tax rate of 3.8% specifically to certain types of net investment income. But it only applies to individuals whose modified adjusted gross income, MAGI, exceeds the same threshold amounts as the additional Medicare tax, 250K MFJ, 125K MFS, 200K others. If your MAGI is over the threshold, the 3.8% tax is imposed on the lesser of 1. Your total net investment income for the year, or 2. The amount by which your MAGI exceeds that threshold, 250K, 125K, $200K. Generally, net investment income includes things like interest, dividends, capital gains, rental and royalty income, income from passive business activities, and non-qualified annuities. You can deduct investment expenses related to generating this income.
Right, that lesser of role again. Can you quickly recap Susie's example for the NIAT?
Sure. Susie was single, her MAGI was $210,000, and her net investment income was $10,900. The MAGI threshold for single filers is $200,000. Susie's NGI exceeds this by $10,000, $200K. Her net investment income is $10,900. The NIIT applies to the lesser of the excess NGI, $10,000, or the NII, $10,900. Since $10,000 is lesser, her NIT is 3.8% of $10,000, which equals $380. So for high-income earners, understanding both the additional Medicare tax and the net investment income tax is absolutely critical for actually projecting their total tax liability and identifying potential planning strategies, perhaps around timing income or managing investment.
Definitely sounds important for those affected. Okay, one last specific tax rule to cover, mainly for families with children who have their own investment accounts or maybe inheritances that generate income. There's something called the kiddie tax. What's that all about?
Yeah.
It sounds a bit playful.
The name is a bit misleading, perhaps. It actually addresses a serious tax planning issue: income shifting. This raises an important question for families passing on wealth, or who have children earning significant unearned income, like interest, dividends, capital gains from investments held in the child's name. The kiddie tax rules were put in place historically to prevent parents from transferring income-producing assets to their children simply to take advantage of the child's potentially much lower income tax bracket. So the basic idea is that a certain amount of a dependent child's net unearned income may be taxed at the parent's marginal tax rate, rather than the child's potentially lower rate.
So it stops parents from using kids as tax shelters, basically. Which kids does this apply to, and how much income gets taxed at the parent's rate?
Generally, the kiddie tax rules apply to a dependent child if they have unearned income over a certain threshold, $2,500 for 2023, and they meet age requirements. The age requirements are: the child is under age 18 at the end of the tax year, or they were age 18 but their earned income didn't exceed half of their support costs, or they were a full-time student over 18 but under 24, and their earned income didn't exceed half of their support costs. As for how much income gets hit with the parent's rate, it's not all of it. For 2023, the first $150 of a child's unearned income is typically covered by their standard deduction, so it's taxed at 0%. The next $1,250, from $1,251 up to $2,500, is taxed at the child's own regular income tax rate, which is often 10%. It's only the child's unearned income over that $2,500 threshold that is then subject to the potentially higher marginal tax rates of the parent. There is an option for parents, in certain limited circumstances, to elect to include the child's unearned income directly on the parent's tax return using Form 8814, but specific conditions apply. So it ensures that significant investment income earned by dependent children is taxed more appropriately, aiming for fairness in the system.
Wow, okay. What a deep dive that was. Seriously. From understanding those progressive rates right at the start, to unlocking the real power of refundable credits, and then navigating all these other key tax areas like estimated taxes, SE tax, NII tax, kiddie tax. We've covered so much ground today. It feels clearer than ever that tax credits especially aren't just minor tweaks or adjustments. They are direct, often incredibly impactful ways to truly keep more of your hard-earned money.
Indeed. I think the material we've explored today really highlights that a proactive understanding of your specific tax situation, really digging into the details, especially around the myriad of available credits, is just an incredibly powerful tool. It's about recognizing those specific opportunities woven into the tax code, opportunities to directly reduce your tax liability or, in some cases, even receive a significant refund. It's about translating what might seem like complex, dense regulations into real-world financial benefits, into actual tax-saving methods for you.
So, as you, our listener, reflect on this deep dive, what stands out most to you? Perhaps it's that idea that a refundable credit, like the EIC or part of the child tax credit, could literally put cash back in your pocket, even if you thought you wouldn't owe tax. Or maybe it's realizing that a simple act like contributing just a bit more to a retirement plan to get the saver's credit, or maybe making an energy-efficient home improvement that qualifies for a credit could come with a direct dollar-for-dollar tax benefit. The possibilities for strategic tax planning for really maximizing your personal tax savings are truly vast, if you know where to look and what questions to ask.
And this raises, I think, one final important question to ponder. Beyond just the immediate financial benefits, maybe take a moment to consider how these various tax credits often reflect broader societal goals. Whether it's supporting working families with childcare costs, encouraging higher education and lifelong learning, promoting retirement security, incentivizing adoption, or even pushing towards green energy, there's often a why behind these provisions. Understanding that why can help you not only save money, but also maybe appreciate the complex role taxes play in shaping our economy and influencing behaviors. So as you look at your own financial picture, your own life circumstances, what small change, what previously overlooked detail could potentially unlock a significant tax saving opportunity specifically for you this year?